Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report, the first weekend edition of 2024. And on this weekend show, we are going to be focusing very much on generalist commentary. We're going to jump around from the broad averages to the commodities, even into energy, and talk about some of the seasonal factors as more generalists share their outlook. So we're getting more of a balanced perspective here. Again, please be sure to visit our website and podcast for all of our daily editorials and especially the company updates, as those will be a bit more focused on individual sectors and stocks. To kick off this show, we are chatting with Mike Larson, editor-in-chief at the MoneyShow. Now, Mike, look, we're recording this about halfway through the day on Wednesday, so we only have a couple days of trading to really assess how 2024 is beginning. And look, so far we've seen, I guess, a short-term reversal here where the dollar has started off the year strong. Yields even have moved generally higher, and that move started kind of in the last week, that shortened trading week in December. And markets have weakened a little bit here along with some of the metals. So overall, Mike, what's your takeaway from the start of the year, and can we make anything out of, again, how the year starts, especially when it's a bit of a shift change?
Yeah, it's interesting. I mean, there is a whole talk of a January indicator. As goes January, so goes the year. But, I don't think there's ever been anything officially proved that as goes the first 36 hours of January, so goes the year, right? I think we've definitely seen, again, just a little bit of reversal here where, dollar pops, gold goes down, stocks give up some of their gains, with tech being particularly weak and so on. That's been the case in the first day and a half of trading, couple days of trading in the new year. But I think more broadly speaking, it's probably just some unwinding of the momentum that we had across the board, people repositioning in a new year a bit and so on and so forth. But I don't think it's more concerning than that, unless this is going to be something that were to continue throughout the rest of the month and then maybe into February as well. So nothing that I'm too concerned about here. When I look at kind of the overall, my overall stance on the markets and sort of the overall take, I tried to sum it up at a recent MoneyShow event we did back in December as be bold, don't fold, ignore what's old, and buy gold. Generally speaking, that means staying long stocks, long energy and metals. Don't fold, meaning you don't want to kind of get sucked in by some of the negative chatter on market breadth and credit conditions and so on. You sort of want to ignore the themes that are old, which is rising inflation, rising dollar, Fed hikes, and so on. And you want to buy gold, which is self-explanatory, but also in the broader sense, buy things that tend to do well in a market environment where the dollar is weaker. So that's kind of how I've framed my investment approach heading into this new year. And I think it's going to be ultimately the kind of thing that we see play out over the quarters ahead. Just a lot of the things that were driving markets in 2023, especially through October, began to fade as we got into the tail end of the year. I think some of the new trends that we're talking about here, again, weaker dollar, Fed cuts, credit environment being pretty solid, things like precious metals dabbling or breaking out to new highs. That's the kind of stuff that I think is going to last and is going to be, more than just a flash in the pan like we saw late in 2023. And I wouldn't be too concerned about what's happened here in the very beginning of 2024.
Well, Mike, I like that mantra. And when you think to most years, no 2 years are the same, obviously, but there are things where you'll see a changing of the guard. And what was the old theme, as you mentioned, worrying about rates and the Fed and inflation, has kind of become passé. Now what we're looking at, and the other thing is in the general markets, everybody last year was pegging the growth in the indexes on the Magnificent Seven. But at the end of last year, in the fourth quarter, we actually saw the market breadth improve. That was a new narrative. Like we saw the Russell 2000 come screaming back. We saw a lot of sectors that were the most beat up bounce back in a big way. And overall, the participation seemed like it came out of the Magnificent Seven and into other market sectors. So is that a theme you think will continue into this year as kind of a new theme?
Yeah, absolutely. I mean, I'm glad you pointed it out because that is noteworthy. It was different. It was something that post the October low really stood out to me. And I think, to be honest, that's what we kind of needed to see for me to stay positive. I mean, it's great to have the same seven names for us all to talk about. I don't think that Magnificent Seven, anything's materially changed there. These companies are doing the right things strategically. They are doing the right things in a business sense, by and large. They do have great earnings potential and so on. But you can't just have a market that's driven by those names to ultimately, in the long term, be healthy. So what happened there to me is one of the reasons why, if anything, I was even more bullish coming out of that October low than I was, earlier in the year, and it's one of the main reasons why I think I, am pretty positive on this year coming ahead. I wouldn't be surprised to see a market where the Mag 7 names underperform and you see small caps, you see global stocks, you see some of these contra dollar type sectors and these underinvested sectors, whether it's financials as another member of that do better and on both a relative basis and maybe even on an absolute basis over time. I mean, it's worth noting JP Morgan, for example, just hit an all-time high on the same day everybody was nervous and worried that Apple gave back a couple percentage points and some of the other AI stocks got whacked. So I think you're going to see, as that sort of recession narrative fades and as the Fed is able to ease back on interest rates because of of inflation continuing to come down, and as the dollar does likely weaken, and as some of the worst credit market scenarios begin to fade into the backdrop, I think that's a market environment that is one where breadth improves, where you look for opportunities in some new names, new sectors, new parts of the market that ultimately didn't do much for you last year and now are likely to do more for you as an investor this year. So great point, and I think it's noteworthy, and I think it's one of the reasons why, again, I'm probably pretty constructive heading into 2024.
Okay, so bullish, I guess, into 2024 in a wider range of stocks. Does that mean we are going to see all-time highs, or for the Dow, continue to see all-time highs as that broad average moved in Q4 and kept on running higher? So 2024, is it going to be a year of all-time highs for the broad averages?
Yeah, I think it's going to be. I think it will. I think it is. It's funny that historically or more recently, the last few years, nobody really does talk about the Dow, right? But here it is. That's the sort of old stodgy index is the one that manages to hit new highs, whereas the S&P almost did before rolling over a little bit, and the Nasdaq certainly had a great year, but still needs a little more to go to get to those all-time highs. That I think is going to be. I think that is somewhat noteworthy, and it's going to be kind of the story as the year unfolds. So. Again, I don't think you're going to see these Mag 7 type names crash or fall apart or anything, but I think you're going to see market environment where they tend to tread more water, and those other sectors are the ones that pick up the slack. So as long as you get stronger performance in the other 493 names in the S&P, even if you have weakness in the 7 sort of top heavy big mega cap names, you can still have a decent year. I mean, I don't think it's going to be this fantastic gangbusters, up 40% kind of crazy year or anything like that. But I think a solid, maybe high single digit, low double digit type year is a pretty reasonable expectation. And I'd also add that, again, within that, if you look at some of those sectors that were beaten up and underperforming, you can get some pretty solid, decent, much stronger numbers out of those simply because the market's underinvested in them and they've been lagging and they have been sort of like, left behind. So that's where the money I think is going to rotate into. And I think that is likely what we're already starting to see early in this year. And if that rotation story is likely to continue as the year plays out.
Well, Mike, let's talk about two of the biggest market governors, and that is interest rates and the dollar. Those are tied to Fed policy. They're tied to financial outlooks. They're tied to whether we're going to get the recession or not. That's the most broadcast recession of all time that still hasn't arrived yet. And when we saw the action coming out of those October lows last year, it was tied to the Fed and other central banks around the world signaling they were basically done with the tightening cycle and we're in a pause mode. And that gave almost all markets across the board a lift, whether it was the general markets, the cryptos, the commodities. Every market seemed to get a lift except the dollar and interest rates. They trended down. Do you expect to see that same weakness in the dollar and interest rates this year, and especially what would happen if the Fed was to actually cut rates as many are anticipating?
Sure. I think what we've seen in the first couple of days of 2024 is just a little taking off the froth, a little bit of, tempering some of the most aggressive rate cut expectations, most aggressive pivot expectations, if you will, for the Fed. So I think that's a little bit of what's behind this developments we've seen in the last few days. But longer term, do I think the Fed has a lot of room to reverse its policies? Do I think that reduction in inflation and some of these other developments we're seeing are going to lead to an easier Fed? Yeah, absolutely. I mean, we can quibble over whether it's going to be 3 cuts in 6 months or 4 cuts in 8 months or blah, blah, blah. I mean, Wall Street will do what Wall Street does and worry about the nitty gritty. But from a broader investment standpoint, I think the takeaway is, look, it's going to be an easier policy environment. What happens in an easier policy environment? Again, the dollar underperforms, things like gold outperform. And I think that you can generally be more aggressive as an investor. Again, you can be more bold if you don't have to fight the Fed every day and come in and worry about Powell or somebody else giving some super bearish, super tight speech and blowing the market up. So I don't think it's going to be a market that gets back to some of the shenanigans and stupid stuff we saw going on with SPACs and this, that, and the other a couple of years ago. I don't think it's going to be that kind of environment, but I do think it's going to be a market environment where money is, on the whole, going to be somewhat easier, and that you as an investor should position yourself to profit or tilt towards that kind of environment and maximize your potential in it.
All right, let's get into some of the commodities and metals, starting off with gold. You've mentioned it a couple of times, and early in December, gold ran up kind of early in the morning or late at night on a Friday or a Sunday night, Monday morning, up to all-time highs, and made another run towards 2,100 late in December. It's still above 2,000 right now. The argument being the gold stocks still have a lot of catching up to do. So, Mike, all-time high for gold, and do gold stocks finally play some catch-up this year?
Yeah, I mean, when you look at the underlying metal, I mean, from a technical and a fundamental standpoint, I think there's there's a very easy bullish case to make and a very convincing bullish case to make. So same thing here. We're sort of dinking and dunking around these levels. Are we going to set a new high? Is it going to be a weekly or monthly high, or is it just going to test and then pull back? I mean, that matters for the short term if you're a quick in and out type trader, but from a longer term perspective, I don't see any reason to be bearish on the metal, and I don't see any reason to not expect all-time highs. I mean, one of our technicians that was at that event, very respected technician, was talking about, a target in the sort of 2,600 level, 2,600 level for gold, just based on the broad base that it's had over the last couple of years. So, I think that a bullish stance for the underlying metal makes sense. For the equities, again, I think some of it is just that the big money needs to be convinced that this is more of a flash in the pan. And once that happens, that's when you're going to see the big boys sort of move into that sector. So if we do get that convincing move, and we do see some, top 2,100 start running towards 2,200, you're going to see a lot of money move into a sector that hasn't seen a lot of money move into that sector for quite some time. So sometimes it feels like waiting for Godot, but I think that honestly, even for the underlying miners, the environment's pretty constructive. The macro view is pretty constructive. So I would continue to lead bullishly there.
Well, Mike, what about in the base metal sector, especially let's just go with the doctor of the whole sector, copper. What do you look into the base metals prognostication for 2024, considering that there still are calls for an economic contraction, but there's a larger group expecting the economy to keep rebounding? How are you looking at base metals?
Sure. I mean, again, I think the issue with base metals to some degree and copper and so on is there's so much tied to what happens in China, right? I mean, that's been the big driver. It was the big driver to the upside. It's been sort of the thing that's weighed on it. I mean, all the demand and the situation in real estate in China and construction in some of these emerging markets pulling back and what that means. So it's a little hard to say, okay, well, if U.S. economic prospects get better for this year, and if we do finally agree that the recession that never came is not going to come, that would arguably be bullish for copper and some of the other base metals. But some of it just really depends on what's going on in China. And until they're not going back to sort of that era of hyper stimulus, all the ridiculous amounts of money they threw at the market coming out of the great financial crisis. So it's going to be a little bit more water treading going on there, I think, especially in metals that are tied more to what's going on in China. So, I like the story for base metals as recession fears fade. I just don't think it's quite as compelling as precious, simply because you're not going to have that dollar kicker. It's going to be a little bit less of a thing. And you are going to have that issue of just, China overhang, China construction, China loans defaulting, real estate construction not getting back to the levels it was a few years ago anytime soon, and so on. So that's my concern there.
One other sector that I quickly want to get your comments on is Bitcoin, because Bitcoin got off to kind of a crazy start to the year, going up over 45,000, but then has pulled back more in this range of between 40 to, I guess, 45,000. Last year was a strong year for Bitcoin after 2022. That was a very bad year for Bitcoin. What's your outlook?
Sure. I think, I'm not a crypto specialist. Like that's not, my main area of focus. So with that caveat out of the way, I do clearly follow it and I listen to what some of our Money Show experts who are crypto experts have to say. And I will say some of the speakers we've had and some of the experts on things like ETFs and, all this process that's been going on with the SEC and how Bitcoin ETFs are likely to be approved and so on and so forth. Those are catalysts for getting more institutional money, advisor money, generalist money, so to speak, into crypto when you can make it a sort of mass market type asset where you have less hurdles to say, I want to buy $20 worth of, fractional Bitcoin. I mean, when you have to go through 3 different steps to do it, that's one thing. When you can just buy an ETF and do it by proxy and not have the performance issues that you have with futures ETFs in that sector, then it's going to attract money. So I think that the big broad bull case there, is probably solid. I would caution that clearly you're going to see a lot of volatility here because there's going to be people that bought over the last several quarters anticipating the SEC approving these ETFs. And then there's going to be people that say, now's the time, it's the top, I'm going to sell because they've been approved. And you're going to, then you're going to see the people that step in and say, oh, now they're approved, I want to get in. So there's going to be a lot of fluctuations. I think that should be expected. But longer term, I look at sort of what happened in crypto and Bitcoin the last couple of years as like the dot-com boom and bust or the housing boom and bust. You had an enormous boom / bubble of all of these people getting in, did a bunch of ne'er-do-wells and shysters and shady things going on. The market crashed, but ultimately there is some kind of use case, investment case, way that crypto is going to be integrated into the financial system and so on. So now you're in that process of, the enormous run-up is over, the enormous crash is over. Now we're going to see who's left, who survives, and what you can do to start getting involved for the long term. So ultimately, I think, again, it's just like with housing circa 2011, 12, once you came out of that bust, there were places, it made sense to buy houses again. It made sense to start dabbling in that sector again. Just like in 2003, once the dot-com bust was ending, there were some tech companies that survived. And, that's why Amazon went from a 99 cents to whatever the heck it's at today. So I think that, it's a similar situation playing out there. So while I'm not a huge crypto specialist, I think just from sort of a big picture cycle approach, there's value to be had. And there's, it's something that I think more mainstream investors want to keep an eye on now because a lot of the dead wood and the bad actors have been liquidated.
Well, Mike, one other sector that has garnered a lot of attention the last 2 years is the energy sector. 2022 was a breakout in the sector, and a lot of those stocks ripped higher in the energy, oil, and gas stocks. But then 2023 was a tale of the reverse of that. A lot of the oil and gas stocks pulled back in a big way. The actual commodities pulled back in a big way. Now it looks like a sector trying to find equilibrium. How are you looking at energy going into 2024?
Again, energy was the strong player in 2022, the dramatic outperformer. It was, weaker and underperforming to some degree in late 2023. I think, there are concerns about whether production cuts are going to be able to be held in place. Some of the worst fears of and crisis-driven buying in the Middle East haven't manifested, which is great for the world. It's not great if you're long energy. So, you've seen some pullback there as some of the money that was rotating into oil and other energy investments, sort of geopolitical fears comes out. But ultimately, I think that, again, and some of it's tied to China, let's be honest. I mean, it's the same kind of thing that weighs on other base commodities and economically sensitive commodities. It's, well, what's going to happen in China? The U.S. can be a big player from economic growth standpoint, but if China is continuing to sort of stagnate, then that's not going to be good for a lot of these base metals and base commodities like oil that are tied to China's economic growth. So I think some of it's related to that. I think that the case is solid to still be long. I don't think this is a sector that's going to fall apart again. But again, I think if somebody said, do you want to buy an energy stock or do you want to buy a financial or a small cap or some of these other industrials and so on that underperformed, I guess I'd have to tilt towards the latter. I don't think energy is going to perform poorly. I still like the sector, but I think there are some things that have been beaten down that are probably going to perform even better. And again, it's some of those things like financials and small caps and so on.
So since we're on that energy front, what about the whole green transition tied in with critical minerals? That runs to, in a way, kind of its own catalyst due to some of the interest and some of the government comments that we've heard over the last 3-4 years now. Mike, what's your thoughts? What's your outlook on this green transition and key catalysts for critical minerals, the wide range of them this year?
Yeah, sure. I mean, it's not going to go away, but I think we did get to a point where the relative cost of EVs versus gas-powered vehicles and just, the cost of repair and the cost of insurance for them and so on. You've seen that like demand has been solid, but it's kind of coming off the boil a little bit here. You've gotten all the early adapters and so on. You've gotten all the people that have taken advantage of government incentives. And now you've seen some inventories build up. You've seen demand cool a little bit. But ultimately, not just from a government standpoint, but from sort of a long-term big picture standpoint, the world is going to transition to that. It is going to be a process that doesn't go away. So I think that the long-term investing case for commodities that are involved with that, for companies that are involved with that transition is still solid. But again, you've seen, at the same time, you've seen in the shorter term some concerns that maybe the push was a little too aggressive. Maybe the assumptions about adaptation and transition were a little bit over optimistic. So we're seeing things cool on that front and on that score. And that probably stays with us through this year. But yeah, I mean, over time, is internal combustion going to fade? Over time, are we going to move to that EV model on both a commercial and personal vehicle approach? Yeah, we will. It's just going to be a thing that I think people need to appreciate. It's going to take a long time, and fossil fuels and companies that produce them and refine them and so on are going to be involved in the energy business for a long time to come. They're not going the way of the horse and buggy manufacturers in a few years.
All right, Mike, we're going to wrap it up here. A lot to take in because we jumped to a lot of different sectors and got your 2024 outlook. Look, it does sound like this year should continue on from last year in terms of some better environments for investors in a wide range of sectors. Maybe not as good as last year because we did see some pretty big gains in some of the bigger stocks and then that broadening out at the end of the year. But hey, as long as we can avoid any major disruptions to these markets, hey, maybe we are just in this consistent uptrend that benefits a lot of investors. So, Mike, always great chatting with you. If anyone wants to keep up to date on Mike and what's going on with the Money Show conferences, check out the link that I will post within that weekend show posting. Mike, thanks for your time. Hope you have a great rest of your weekend.
Thank you, Corey. Take care.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Providing unique reporting on markets and companies since 1990. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And in these final two segments, we are chatting with Dana Lyons, fund manager based out of Chicago, also editor of the Lyons Share Pro website, which I should note, Dana is running a holiday sale, extending it another week for all of you listening. You get 20% off at the Lyons Share Pro, so I will post a link within the weekend show posting where you can take advantage of that. And Dana, as we usually do with you, we're going to go around to a number of different markets and sectors to get your more technical outlook on these sectors. Before we get into any individual sectors, though, it seems like the environment we are in here where a lot of markets and a lot of sectors are trading hand in hand with each other. 2023 was a good year for a number of different areas, especially at the end of the year where we saw a more broad-based recovery, money hitting a wider range of stocks and moving those higher. As we turned over the calendar, seems like we're getting a little bit of weakness on the back of all that strength to close out 2023. Dana, what do you do at the beginning of these years when, look, we are seeing everything trade together, and now we're seeing a little bit of a counter trend move?
Yeah, thanks, and Happy New Year, guys. January, we spoke about this just prior to coming on. January is a little bit different that we perceive than any of the other months of the year in that it typically is kind of it tends to be like a whiplash type of a month. So you see a lot of counter trend moves during the month that quickly get reversed. So whereas, a lot of the old school pundits will look at the January barometer, so goes the year as January goes. I see less and less of that and more of however January goes, we tend to see a reversal of that. And I would not be surprised to see that just because of how the intermediate term conditions are. The market data, specifically within our quantitative models, is still strong in the equity market, portraying that, like you mentioned, the broader strength in the markets, not just the Magnificent Seven. You had a lot of broader participation in the rally, especially in the latter part of November, December. So you've got a decent foundation under the market still to perpetuate this rally. And what I think you're seeing is, as we spoke about, a couple of weeks ago into the end of the year, you saw some short-term froth in terms of some momentum conditions that were very overbought, historically overbought, and also some short-term sentiment readings that got a little bit frothy. So you had conditions right for a pullback, and then you had, like I said, when we switched calendars to the new year, you often see kind of a quick reversal of the trends that were in place, and we're seeing that right now. So at the moment, we were a long way away from seeing any data come in that makes us suspect of the durability of the post-October rebound. In other words, we think there's still got more legs to the rally, and certainly would put our bets on this just being more of a short-term pullback, correcting some of that overbought nature in both sentiment and momentum. So are we looking to buy the dips for the most part in risk assets? Yes.
Well, Dana, I think what you just said is so significant, and I'd like you to unpack the concept a little bit more of looking at things in different time frames, because I think a lot of people get hung up on that day's price action, or, hey, how January kicked off the year, and they're extrapolating that out through the rest of the year. But really, what you just outlined is very cogent in the sense that, yeah, in the short term, things were overbought. They were getting a little frothy at the end of last year. The sentiment readings were a little high. Now sentiment swinging back down, but you can separate the short term action from the medium term outlook in your model. So maybe just speak to looking at the markets in different timeframes and knowing when to buy the dip and when a larger trend's at foot.
Right. Well, if you got so highly influenced by every swing in the market, you'd think everything was a bottom or a top, right? So you'd be perpetually either fearful or greedy. So you have to kind of pick your time frame. And after many years and decades of study, we settled really on the concept of an intermediate term time frame for our models, which is generally from 2 to 6 months, sometimes more. But it generally encompasses moves in the market that are large enough that we think it's worth trying to capture or avoid. So you're going to get decent moves in the equity market of 10-20% or more within that time frame, as opposed to more day trading or swing trading where you might get smaller 3, 4, 5% moves that maybe to us is not necessarily worth trying to capture every single ounce of each one of those short-term swings or iterations. We're, as long as that data that distinguishes that intermediate term trend according to our models is still bullish, which it is now, and is likely to continue to be bullish unless we see a massive rug pull, then we want to continue to concentrate on the upside and look for opportunities into pullbacks to add to our long positions, as opposed to we see a short-term pullback and we're trying to reverse directions. If conditions were long in the tooth, if our models were a little dicey and more suggestive of a potential top, then we'd probably be getting more defensive into conditions like this. But the way it is now in the intermediate term still looks good to us. So into any short-term pullback, which, like I mentioned, we were frothy in terms of momentum sentiment. There is some short-term room on the charts down to more significant support levels, so we could come down further, but we want to focus right now on using that short-term weakness to add to long positions that we think will continue to work in that intermediate term.
So let's talk about potential levels for where the S&P could correct to, because it was almost a perfect 2-month rally that went up about 17%. So far, the markets just in a few days, including the tail end of last year, have corrected a little over 2%. So where do you see the next stopping point, a good buying opportunity for the S&P?
Well, for the S&P, it's not much support until maybe decent support around maybe that 4630-ish level, I guess. And then the major support comes in down in the lower 4500s. Don't know if we'll get there. If we do get there, we'll probably be buying it very aggressively. But we like to, as you know, we like to cast a wider net out there in terms of potential investments. So we're not just staring at the S&P chart. We're looking for relative strength in the market. So there are pockets of things, specifically in the tech sector, which was the most extended and the most vulnerable, that have corrected the most since the end of last year, really this week, I guess, that have already pulled back and already hit some at least initial levels of support where, considering our intermediate term more rosy outlook, we want to be looking for opportunities to get to dip our toes in or to increase our long exposure. So we've been dipping in a little bit this week in some of those tech names that have corrected the most, that are now already hitting some measures of support. Again, there's certainly room on the charts for further downside in the near term. And if we do, if that downside does manifest, we'll certainly be a little bit more aggressive in buying that dip.
Well, Dana, you've also noted to us that in addition to the growth side of it, the tech and some of the small cap stocks that rallied hard in the IWM last year, that you're also looking again at value, and that there's some relative strength in some of the value funds you're looking at. Maybe break down the contrast between growth and value.
Sure. And obviously growth has been the name of the game for really several decades. A couple of years ago, we saw value make a stab at reversing that longer term trend. We still think there's a good chance that more of a secular shift is in the works towards value. But we've seen, over the last year, obviously growth pretty much rose from the dead and said, the run's not over. So we've seen a nice bounce back in growth. But at the same time, value, after taking a backseat last year for most of the year to growth, has rebounded pretty well. And specifically looking at some of the what they call pure growth and value, pure style indices. And basically those strip out any remnants of the other side of the coin. So looking at pure value indices, it strips out any of the growth aspects. And several of those indices have really bounced back strong. And interestingly enough, it's really the small and mid cap that have bounced back the strongest. So one ticker symbol be an ETF, the mid cap pure value ETF ticker symbol is RFV, has, after bouncing at all-time highs a couple of years ago and consolidating for a couple of years, just broke out a couple of weeks ago or a month ago. Nice breakout, pulling back towards that breakout level. But we think that's got massive upside going forward. And it's small cap brother, which would be a ticker symbol RZV, which, in studying all the growth and value indices, this particular index or fund, from our study, really more so than any other style index, really is a barometer that we found for kind of the risk off, risk on phenomenon. And when it's going well, generally the market in general is on good footing and vice versa. So right now, after it kind of did the same thing that the mid cap fund did, we had a nice recovery off of the COVID lows, went to all-time highs, and for the last couple of years has kind of been consolidating that move, but it's held up very well, more so than something like the Russell 2000, more popular small cap index. In fact, it just in the move towards the end of the year, RZV did challenge or test the previous all-time highs and consolidating that. So that's another one that into this pullback we'll be looking to buy. And if that breaks out, then it's got considerable potential upside there. And as I mentioned, it's historically been a very good barometer for risk on versus risk off. So when that's going good, the market in general tends to go good. So that would be an extremely good, extremely constructive sign for the market overall, at least, at the time being.
Okay, so overall, still in that, I guess, more bullish camp for the markets, and seeing even more reason to, I guess, jump on any corrections here because of the more broad-based recovery. Let's move over to the bond market then. And look, for as much as we've had you on the show, we do understand that you do see kind of that bigger picture change in rates, where we're probably not going back to those ultra low interest rates, but look, we've seen a lot of volatility in rates to end the year. 10-year moved up to almost 5%, then moved whole way down below 4% just in a matter of a couple months. Is, again, kind of rebounding at the tail end here. Bonds, that means that they're selling off, which kind of is going hand in hand with a little bit of the sell-off that we're seeing in U.S. markets. Where's the sweet spot for bonds or for yields currently?
Right. And as we have talked about it for years, we do think that 60-year cycle in bond yields bottomed out in 2020. So that long bull market in bonds we think is over. So probably go heading higher in terms of bond yields for several decades to come. And probably people would be shocked to hear, but probably headed back up into double digits eventually. But nothing goes in a straight line. So looking at some key retracement levels going back to the highs in the early 80s. The first key level is around that 4%, just above that 4%, where yields did top out in 2022, went sideways for about a year, and then really during the fall when we saw the weakness in equities, we saw bond yields break out above that level, and that's really the line in the sand. We did rally up towards 5%. Then pulled back over the last several months, coinciding with the equity rallies. We've seen 10-year yields pull back all the way down to test that key breakout level around 4%, even inch a little bit lower. So this is a massive development in financial markets. I think right here is whether or not bond yields hold that breakout level around 4%. If they do, we've got a lot of upside straight up towards probably 6.5% next. On the flip side, if they cannot hold that 4-ish% level, then we've got a false breakout on the charts, and that would open up further downside in yields, probably 3.25, maybe back down towards that 270 level again that we saw last year. So big moment, big test here in bonds. We have just in the bounce in yields this week, we have gone back long, hinting that we do think evidence points to maybe a false breakout and a drop back down below that 4%-ish level in the 10-year. Just looking, for example, at one piece of data, if you look at the TLT, for example, and look at the amount of volume that's gone into that fund, especially at the lows in October and even during the rally since, it's been a massive amount of volume. So you see the most volume at lows in the market, and it's been interesting to watch the volume maintain itself during the bounce. So that would be one hint for us that, okay, maybe it was a false breakout in yields, and there is much more to this pullback in yields, bounce in bond prices. And certainly that, as you guys know, I don't like to play that intermarket analysis, but that would certainly coincide, further drop in yields would probably coincide nicely with the continuation of the rally in equities eventually after whenever this short-term correction is over.
Well, Dana, yeah, I know you don't like doing the intermarket analysis, but a pullback in rates isn't just good for the equity markets. It's also been a boon to gold. Gold is very closely correlated with interest rates, and when they're pulling back, gold seems to do well. We had a pretty strong close to the end of last year in the gold market, but how are you seeing the setup for the yellow metal and the precious metals sector in general for 2024?
As we've spoken about in the past, we're pretty positive on gold itself, especially. Pretty much carved out a kind of a modified cup and handle pattern since those highs back in 2011, or matched those highs in the COVID year, and basically have maintained those gains pretty well, even moving sideways over the last 3.5 years or so. And the fact that we've held up well, I would say, argues for an eventual breakout there in the yellow metal and another significant up leg there for gold. So we are staying long, gold especially. Obviously, the miners have had a bit of a tougher road of it for whatever reason. We are long the miners as well to a smaller extent. But if we get that breakout in gold, that should be a boon to the miners as well. Obviously, that they'll have to contend with whatever the equity market in general is doing, but a breakout in gold obviously should be a big boon to the miners, and I would suspect that's on tap. Whether it happens this year, I don't know. I would say we're pretty well positioned for that to happen this year, and we are again, we're long gold right now, but what the specific timing of that, I don't know, but you could say yes, we are certainly bullish on precious metals, especially gold.
Can you give us some more insights on what you are seeing in the gold miners chart? So let's just focus on GDX and what a breakout in your eyes would look like, what levels you're watching for, just what you see in this chart that, in all fairness, does look just slightly different than the actual gold chart.
Yeah, for sure. Like I mentioned, you got different forces pulling on the miners. Obviously, you've got the precious metals itself, and then you have obviously the equity ties within the miners to the rest of the equity market. And, where we saw, in 2020, we saw gold rally all the way back to those to match those highs in 2011. Interestingly, GDX bounced back to just about exactly tag that 61 retracement from highs in 2011. So lagged quite a bit, continues to lag quite a bit. Why that is, I'm not sure in terms of a fundamental reason, but certainly has lagged. So we'll wait till better technical setup to get very aggressive on the long side. But we are long, like I mentioned. I would say break above 33 would open up a move towards the highs from last year on 36. But you've got a series of lower highs ever since that 2020 high that we saw that obviously leaves some damage, some carnage on the charts that makes it a little bit tougher road to hoe. But certainly, if we get that breakout in gold, that'd probably be about as good a factor as the miners could hope for. And again, I would suspect that would be coming at some point.
Well, Dana, let's move over to another market widely followed by our audience, and that's the energy space. How are you looking at oil, nat gas, but also the oil stocks?
Yeah, oil, kind of middle of the road. We've been talking about it, for several months. Kind of stuck in a trading range like so many of the commodities, to be honest. It's hard for us to get too aggressive either way. The dollar as well, kind of been stuck in a trading range, I would say right now. In the short term, benefit of the doubt is probably to the downside still in crude oil. With that being said, we do have a decent allocation to energy stocks that have been in a nice uptrend for the last couple of years. Obviously, have underperformed since the low in October, but that's mostly because they outperformed, especially during that equity pullback in the fall. So we still have a series of higher highs, higher lows in the energy space. Oil services, especially we continue to like OIH, a bigger symbol, but we do like the energy stocks, and that's one space. And I think we talked about it last time. If you're looking for areas to buy that aren't, extended, that didn't get too frothy, energy is one area that you might think about in terms of sectors that are still in the intermediate term demonstrating decent relative strength, and in the short term are not frothy. They don't have that quick air bubble or air pocket below them on the chart like so many things that have bounced so much over the last couple months potentially do.
Yeah, looking at XLE and OIH, just going back to 2020, that's a very good point, Dana. It's been kind of a consistent rise. Higher lows and mostly higher highs, except for in XLE, the energy sector ETF here that was, again, kind of range bound throughout pretty much a year now. Does that mean that if we continue to see these higher lows, that these are, in a way, these sectors just continuing to build up momentum to the upside? Could there be a more aggressive move to the upside in either of these?
Yeah, with the oil services, the higher highs, higher lows just signifies, there's continued demand out there. And it shouldn't be surprising, even though, we're a couple of years into the bounce. If you scroll back, we saw basically a straight down move in oil services for, the better part of a decade or so. There is certainly some pent up, just some mean reversion potential to the upside in terms of potential allocation funds coming in or rotation funds coming in. So from that standpoint, I think even though we've seen a decent bounce, there's plenty more room to go considering the longer term. Still not frothy or even richly valued whatsoever. In terms of XLE, kind of a different story. That's back up, kind of testing near those highs that we saw, about a decade ago. The good thing is we saw that rally from 2020 into 2022, and it's held up nicely. We haven't seen the higher highs like we've seen in oil services, but is pretty much consolidated right near those highs that we saw starting a couple years ago, and putting in potentially a type of ascending triangle. So we're seeing higher lows, we're seeing basically approximate tops. So that would point to, at least classical chart analysis would point to an eventual breakout there, and another extension of the rally that we saw starting back in the COVID years.
All right, Dana, thank you for covering so many different sectors with us and sharing what your models are pointing to, a lot of it being some more shorter term trading. But hey, you've played these markets and the swings pretty much perfectly over the last couple of years, which has been a wild ride for a number of investors. And it has shown that you can't get too dug into any one position or any one narrative, because markets change and all sectors can kind of follow along, and some of them do actually play off of each other. But again, don't get too bogged down into one narrative, especially in times like these where there are a lot of things changing in the economy and especially with central banks. Dana, thank you for your time on this weekend show. Everybody, thanks for tuning in to the first weekend show of 2024. We hope you all enjoyed it. And as always, keep in touch with us through email and on our website. Pay attention to all the daily editorials and company updates we record throughout the week. Dana, everybody, I hope you all have a great rest of your weekend.